Okay, hello everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Michael Boutros here with you guys. We just have under a minute before the release of U.S. retail sales. You're looking at a chart of the dollar index right below. Eileen, good morning. Mark, Permendra, Depeche, Hussein, Cameron, Vesco. We got the whole crew in here today, so great to see you guys. About 20 seconds out. Again, expected print is 0.3% month on month for August. We'll be looking for that ex auto and gas core retail sales as well. Looking for your hold at 0.4%. And survey says a little bit of a delay here. 0.3, a little bit weaker on core. Headline also came in at 0.2%, just shy of expectations. So all three reads, essentially, metric reads for the retail sales sector coming in slightly weaker than expected. You'll probably see the market shrug this off because of this. You have an upward revision for the headline figure from last month. Core from last month got revised up significantly from 0.4 to 0.7. And even control moved up 0.6%. So wouldn't really look too much into that print. You'll probably see the dollar index, hold that recent range that we've been in for Asia Pac through Europe. And we'll have to look for the next release. Industrial production comes out at 9:15. Not expected to be a major print for the month of August, but we are expecting contraction. The event risk continues, guys, all the way till the FOMC interest rate decision. Tomorrow you have CPI data, which is likely to be much more impactful than today's print was. If we look at what the expectations are there, we are expecting a slight slowdown in the month-on-month number. Core read, which is what the Fed will be really fixated on, is expected to uptick to 1.9. So it's specifically right ahead of the FOMC. If they do see an uptick in core inflation, it makes it all the more hard for us to make a call of what's going to happen on Thursday. Remember, the Fed's dual mandate: price stability, i.e. inflation, and unemployment, which is basically where they want it to be. Mark says, don't understand those revisions. What they are basically saying is, oops, we made a mistake last month. Not necessarily, Mark. As data continues to come in, they continue to compile it, even past the calendar date that they've been in. So, for example, after the September read, all through October, they'll be getting in little bits of data still from the September calendar month. They incorporate that into their current model, and it spits out a new number. So sometimes the revisions can mask weakness, meaning the revisions can sometimes come down, or sometimes the revisions show that, hey, not all the data was represented and the market's actually stronger than expected. Does that make sense, Mark? Because remember, they're compiling data from all over. He says, oh, I see. Okay, thanks. Yeah, anytime, man. So definitely something to pay attention to. And on a print like today, if you're not paying attention to that, someone will say, well, wait a minute, we missed on all these CPI numbers, and how come, dollar isn't tanking? Well, again, we're offset by some of those numbers. So still looking lower. Key resistance, a little bit of an adjustment to the levels that we highlighted on Sunday. I posted this chart also on the radar charts last night. Still key resistance, 11,989, which is also now going to be basically the weekly open. Okay, so look for that resistance near term on the dollar index. Relative performance before we move into the charts looks like this so far. Still got the yen strength going strong, up 0.49%. Obviously, both of the intraday charts from last night's update were well, one of them was on dollar yen. The euro yen scalp from Sunday night still in play, looks beautiful. And we'll also go over some relative positioning in the euro dollar, which might not be quite primed for a move just yet, guys, but the opening range for the week looks phenomenal. So we'll definitely take a look at that. As always, questions, concerns, setups, specific periods you want to look at, keep them coming, and we will jump into them as soon as we get through these setups. All right, let's jump right in. So, looking at, first things first, the dollar yen. So the dollar yen, actually, we were in a long position on that yesterday. Here's what it looked like on the daily, okay, after we rebounded off this key support. So remember, 119.88 was actually, if I can remember correctly, it's the yearly open, isn't it? Yes, so it's 2015 open. Then you had the median line off the yearly high, which came right into that region as well, and you saw a nice rebound on it. So I was actually long in this pair, looking for that rally into that median line, which we rebounded off of last week. That also coincided very close with the 200-day moving average. Booked profit a little too early on that one, as I noted in the piece yesterday, with the rally offering an ideal short entry. So we are still looking lower. Bias hasn't changed on the dollar yen. I'll show you the opportunity that we got into last night. Here's what it looked like, excuse me, on the 30-minute chart. And again, I might have jumped the gun here by jumping out of the trade a little too early. You did get the stretch into 120.47 and even higher with that basic trendline resistance off last week's high, catching it in a real nice trigger as momentum held 60, giving you a real nice move to the downside. Here's what it looks like in the 30-minute now. All right, so you saw that stretch right there, 60 more or less held. You saw a quick recovery right back below. On a 5-minute, there was also an awesome trigger that gave out with a stop against the highs here. You're looking for about 31 pips, looking lower. Here's what the intraday chart looks like now, or the scalp chart rather. Dollar yen's here somewhere. Okay, and basically, well, okay, so this actually doesn't represent the whole position. I took off half the position as we came into that high right ahead of the U.S. Close yesterday, which was 120.15. So if you remember, 120.15 was a soft target on the upside. So just ahead of that, we did jump out of a piece of the long position ahead of the 5 o'clock calendar, which is why you don't see the arrow there. And then here, again, some divergence into the highs and a quick rebound off that 70 level scared me out of that position. And I closed out a little bit early, right before another 30 pip stretch to the upside. But long story short, there's the trigger from overnight, right at the highs. And if you had missed that trigger on the pullback, there was another opportunity to get short with this one. And that was the ideal stop because you had to stop just, 12, 15 pips away. You're looking for about 31 pips, risk to reward 1-to-1 or 1-to-2. 2-to-1, excuse me, is going to be my favorite type of way to take these positions. So unfortunately, it was writing the piece and publishing it when that trigger gave out. So long story short, we are looking lower. Near term, we could get another pop back towards the 120 handle in U.S. trade today. Remember, you're unlikely to see any major stretches in these dollar crosses right ahead of FOMC. Again, we have CPI inflation tomorrow morning, so stay nimble. But, we'll be on the lookout. And a perfect example, guys, of how, even though the broader bias, we've been bearish in the pair, there's still opportunities to take long scalps in these positions. Original position size here was half what I typically would take. And again, as soon as we click those 31 pips, start to peel them off. There was one exit here. I think there was one more exit, 120.25 right here. And then the final exit there for the final piece. But long story short, after that, we're looking for short triggers. Just so happened about an hour later, you really did get a very strong trigger back to the downside. And again, that was based on the fact that 120.80 remains the bearish invalidation level, or was yesterday. So at this point, we want to bring that bearish invalidation level just a tad lower. I'm going to bring it into that 120.15 level that we played off of yesterday. If you get a break above, the basic trendline resistance that we reacted off last night, you're likely to see a rally right back into 120. Keep in mind, the short needs to really clear this range. This is pretty big. Okay, the yearly open, the median line, I know we probed below it, but it's really imperative on a daily basis that we close below this if we're going to make the downside snap here. Any questions on dollar yen before we move on? Cameron says, hi, Michael, it's my first day today. Welcome aboard, my man. Says, I'm finding it a bit hard to understand where to buy or where to sell. Please guide me how I can learn more about it. So Cameron, I would encourage you to go through the resource section just to get a little bit more familiar with the terminology that we're using here. So on SB, on that resource section, you'll find some more information. There's also a scalp webinar there that we went over the basics of kind of how we move through the levels. So I'd encourage you to go through that. Other than that, these webinars are your best place, Cameron. Ask as many questions as you'd like, my man. We're basically mapping out our key levels or scalp targets. Then we're working with a near-term bias. So the near-term bias I will dictate for you on the daily pieces. And for example, yesterday, continued to say that we're looking for short triggers in dollar yen. So we're looking for rallies to sell. We're looking for momentum triggers in RSI. So basic support and resistance, just as you do in price action, can offer you, real clear-cut triggers when associated with price for entries on a trade. All right, so I definitely would encourage you to ask as many questions as you have. As far as yesterday's entry, one other thing I wanted to show you, where was the entry right here? Here was the entry for yesterday's dollar yen trade. And another example for you, Cameron, we talked about this actually in yesterday's Daily FX webinar. Dollar yen was coming into some near-term support. The confluence there of that median line we talked about off the yearly high and just a basic channel support. So you're coming right into support. You're looking for markets to give you a little rebound. All right, and there was a clear-cut trigger. So some divergence, price action making a lower low into a trigger break, resistance, gave you a super tight stop. I think I started this one with a 10 pip stop. As soon as we booked initial profit, we went to break even, and then the rest is history. So it's all about pinpointing your most ideal entries. This is a 1-minute chart, by the way, guys, and I have found that getting more granular in this specific market has sort of worked out for me. So this line you see here was actually taken off the 5-minute. Let me show you what that trigger looked like. And that's this right here, which is one of the reasons I jumped out of the long position, because I saw that trigger gave out, and I figured, hey, we're well above the quarterly ATR here, might as well take it. You got another stretch into the highs, but the operable trigger on the 5-minute would have been here. So the 1-minute chart's been giving you some nice entries lately. Any questions on dollar yen? Looking to sell rebounds, could get a little bit of upside swing here from support, but long story short, we're going to reduce that bearish invalidation level to 120.15. The other chart from yesterday, and then we'll go into the radar charts and take your questions, is the euro dollar. And the only thing I wanted to highlight here is, look, it's a really complex setup and it looks pretty messy on the daily, but actually when you break it down to the weekly setup, it's as clean as it gets. Here's what euro dollar looks like on the daily. And a quick reference again, yesterday we rebounded off the confluence of the 1618 extension off the lows and the former lower median line parallel, okay, and gave us a nice kickback to the downside. We remain constructive on euro. So the broader trend is weighted to the upside while above 112. And this for me is what's going to shift the whole deal. So 112.08 is actually the monthly open. You have the lower median line parallel here for the broader structure off the lows. And if we break below that, it would also necessitate a move back below the 200-day, and it would sort of, mess up the whole idea of a little bit more of a euro stretch to the upside. Wouldn't be surprised to see this drop, but that would offer, for me at least, I'd be looking for long entries. Looking at a chart I posted on Twitter yesterday, Eileen says, liked your bearish invalidation instead of, oh, I liked your bearish invitational instead of invalidation. Did make me look twice. Dollar yen, your chart last night. Did I say invitational? Oh, I did. Oh, I'm glad you point that out. Okay, well, I like that you, thanks for pointing that out, Eileen. I had no idea. I will edit that as soon as we get through here. But you get the picture, right? That's funny. What was I going to say? For euro dollar, if we get down there, I'll be looking for long triggers. But here's what the intra-week looks like, and it's super clear. And one of the things that I like to use, guys, as you know, is the opening range for the week. So Cameron, one of the things that we use to ascertain what the near-term bias is going to be is looking at the weekly opening range. So the markets will tend to set a high, set a low, test that high or low, and then make a break. So right now, as it stands, the weekly opening range is pretty clean. Here's your Sunday high. You stretch into a low, you're going to look either for a defense of this low or a defense of this high. And once we break this range, that's your directional bias in the near term. And that's just based on the facts that, guys, markets will tend to put in their lows and highs, their extremes, on the extremes of the week. Meaning if we put in a Monday low, we'll typically put in a Thursday, Friday high. If we put in a Monday, Tuesday high, we'll typically put in a Thursday, Friday low. And I mean, here's last week. You put in the low on Monday, you put in the high on Friday. So it's a very basic, objective way of studying price action that can give us intel into what we should be looking for in the immediate term right now. So I just wanted to highlight the dollar yen, or the euro rather, specifically because of the resistance that we came off of. If we make a downside break of the weekly opening range, there might be beautiful opportunities here to get some short scalps into this support, but this is where I'd be looking to get back on the long side, okay? Or if we break the opening range for the week to the upside, well, really nice objective targets at 114.35, which is going to be the June high, and then 115.12 would be the next objective target, which is the reversal day close that we made. Okay, so it's always important. I noted in yesterday's piece, it's always important to map out the levels before the fact. You don't want to wait till the markets start moving, then look, where's resistance from here? Where should I be looking? To find my entries. Everything's mapped out. The levels are clear to go. We're just looking for some conviction on momentum, which you don't really have. Here's the start of the week. Here's the 40 hold in momentum. Here's the 40 hold in momentum. So we'll want to see that change as well, but the levels are pretty clear. Levels are pretty clear. Any questions on oh, Mark, thanks, says I like that chart on Twitter. Yeah, the chart I wanted to show you was the euro dollar weekly. And just to put you in a little bit, it's always good to get some perspective of where we are in the broader charts. Here's what the weekly looks like. So you can see a scenario. Let me bring back that euro dollar 30-minute there. You can see, you can see a scenario, guys, where we get a little bit more of a pullback into 112 here. Wouldn't be outside the realm of possibility. Keep in mind that the 13-week moving average or the quarterly moving average takes it down into like 111. Before you invalidate or start to, overturn any major biases here for the euro. This is pretty big resistance, not just based on the 100% extension, which happens to line up pretty nicely with our levels right now, but also momentum. You're right at that 50 region. If you see a 50 break in momentum and a pop through, I wouldn't be surprised if this thing runs into 118. Okay. And with the same respect, if we start to break the recent weekly lows that we made, which is just riding on that quarterly moving average, I mean, then even on the downside, you really don't want to look beyond 109, 109.60. So with that picture in view, and then with the daily where we are right now, it's really a crossroads here for the euro. Generally speaking, from a scalping perspective, I'm still in the mentality of buying dips. Ideally, 112 would offer us some nice entries for the long side. All right. So that, my friends, is the euro dollar. I'm going to segue real quick into the euro yen before we go over the radar charts, just because I think that setup is also, clearly in play right now. Here's what euro yen looks like. And first with the daily. So euro yen was highlighted on the Sunday open. Here's what it looked like as we opened up the week, and we were basically holding within the confines of this nice ascending formation on the near term. The daily chart really highlighted the major resistance that we were coming into, which was basically the upper median line parallel for the formation off the yearly highs. And this is on the back of a 5-day stretch to the upside, guys, a 6-day stretch to the upside. So the risk was for a pullback beyond this region. Near-term support 135.80 marked the confluence of not only the 200-day moving average, but that sliding parallel, the monthly open, the works. This thing was loaded here. And that downside break gave us further conviction near term to favor the short for euro yen. So here's what the scalp looked like. Again, we were opening the week right at resistance, 137.04. This chart that you're looking at right here from Sunday, that actually turned out to be the most ideal entry for the entire week. You had some divergence into the highs, a trigger break broke, and we've been spilling to the downside ever since. Major key support did give us a rebound, but here we are testing well below that level again. Here's what the scalp looks like at this point. So the levels are unchanged. We made it through 136.40, key support 135.60 into 80, that major region we looked at on the daily chart. Like I said yesterday, here was a beautiful long opportunity again. Even though the bias is to sell rallies, if you get a clear-cut signal for a rally near term, again, we'll be lighter on the leverage, but there's no reason not to take it as long as you have a good risk to reward in play. And here you had one yesterday. So another long opportunity. I probably would have peeled this one off right at 36. You went right into 36.40. And then again, another short trigger last night. I know that swing trades were looking for a 36.44 on the entry. I'm not sure if you guys actually caught it, but you really had a nice trigger on the near term to put you back on the short side. If you took that trade, half of it's out at 35.60. I'm still waiting for the drop into 35.80. Stops are at break even. So if we get the drop, great. If we don't, we'll look for another re-entry up here near that 136.40 level, but really clean setup again, and everything remains unchanged as far as the levels are concerned from Sunday. In fact, now that you have some price action for the week, one other thing I like to do is just add some clarity, add some guidance to what's going on. So I'm just going to eye this out, but if I look at basic trendline resistance, further highlights this region now. Okay, and look at that, pretty clean. And then the nature of the descent sometimes on the measured moves will also give you a tell. So let me just see if we have any extensions that come up. Oh, sweet. Okay. So you can see further conviction, whatever you want to call it, on our levels. 100%, two equal legs off the high takes you right into a 38.2 retracement. That gets you 134.84, 134.80. And the 1618, nice line up here. Three-way confluence, 133.80, 133.88. Okay, near term, or the immediate bearish invalidation is going to be that same region. Okay, so if we break back above that 135.80 level, the 200-day moving average essentially, you would look to not necessarily turn bullish on it, but I'd go neutral on euro yen if we make a move that high. All right. If the euro dollar setup from last night starts to materialize, you get a little bit of pull lower, right? And dollar yen's been a beautiful play. You might see some really nice moves here in euro yen exacerbated to the downside. Remember, a larger range scalp here, 36 pips is what you're looking at per scalp. So keep that in mind, but still looking pretty good. Go dollar yen. Go euro yen. Okay, so that's euro yen, and let's take a quick look at the radar charts from yesterday, and we will jump into your question. So dollar index we went over earlier, but just a quick look at what that's doing now post data. Okay, resistance still on lockdown here, 11,983, 11,989. Here's the dollar looks like on the daily charts to get some perspective here. And this is the same chart that was posted on Sunday as well. This is going to remain our near-term bearish invalidation level. 12,028 represents the monthly open and also confluences with the upper median line parallel there. So I know that's a ways away from where we are now, but you got to open it up and really keep the larger picture in mind when you head into major event risk like FOMC on Thursday. So you're coming at some near-term support, namely that lower median line parallel from the yearly, from the April-May lows. That confluence is the 50%, starting to get a little bit wider range of support here, but you could see a little bit of a rebound to the upside. The intraday chart is really what I've been focused on as you start to lose a little bit of efficacy here on this downside stretch. The intraday chart still pretty clear. So we're within the confines of this formation off of last week's, I guess this is just the September highs. And if we see a break above this today, expect that recovery, okay? back towards basic trendline resistance off the yearly high, off the September highs, excuse me. And that's basically going to take you into 12,012. And again, bearish invalidation level is still going to be at the September open. So wouldn't be too surprised if we start to go into a little bit of a snooze session, guys, after tomorrow. Tomorrow's data release is still likely to give you some volatility just because it's the inflation print, and that's going to be really, really critical to the Fed's decision on Thursday. Remember, the Fed's policy meeting actually starts tomorrow. The release, the press conference, and the quarterly projections will be released on Thursday. The other two charts from yesterday's radar charts was the Kiwi Dollar. So this one's for you, Cameron. You're looking for the Kiwi. It's right here, man. And again, remember that long that we talked about? I think Jamie is still holding it. Remember that long we talked about last week? It's still the preserved low for the Kiwi, believe it or not. So daily chart doesn't really have much to look at. We talked about this last week at length. So Cameron, specifically for the Kiwi, man, this is a perfect example of a monthly opening range that is super clean. Last month's opening range didn't give you jack, neither did the month before, but heading into the June opening range, here's the June open, you set a low, you test the highs, it fails, you break, you close at the lows. Last couple of months have been kind of tough, but here you are with a really clean range again to start September trade. So if we break the highs, we're bullish against the lows, looking for that late month low. If we break the lows, we're bearish against the highs, looking for a late month low. And the weekly opening range, just as clean. Okay, just as clean. So here was that entry that we were talking about last week that turned out to be really nice. You had a really tight stop. You know, you're well off that mark already. Here's the near-term formation we're looking at. And it's just happened to catch all these swings with, you know, precision. Near term, the confluence of the 618 from that latest drop and the median line from the lows takes into 63.60. And that's what I noted yesterday as sort of the level that we need to get through to really get the conviction on playing a little bit more of a reversal play higher for Kiwi Dollar. Now for Kiwi, one other thing I wanted to say is you have to keep on tap. Remember that it's going to be a double whammy in Wednesday and Thursday. Wednesday night, you get the GDP figures out of New Zealand. Friday or Thursday rather, you get the FOMC. So you get hit with event risk from New Zealand. Then, you know, within 24 hours, you get event risk from the US. So it's likely to be, I mean, I think we're likely to get some more definitive price action on the Kiwi Dollar. But for now, we'll leave it on the radar. I'm just looking at the levels, which continue to remain very clear. And the opening range for the week is also, you know, super clear here. So this is like the cleanest ideal opening range you can get. You've tested the highs 3 times, you've tested the low 3 times, and you look for a break of that. Momentum, 60 hold, 40 hold. You look for a break of that in combination with a break of this near-term range. It gives you the bias. Once we've got that down, now we're just looking for triggers. It's not necessarily going to trigger a trade, but it's going to trigger our bias. So I know that I should be looking higher, looking at buy pullbacks, looking for momentum triggers, and proper risk to reward trades. Cameron, does that help on Kiwi Dollar? Look, we don't want to be the ones trying to call the low. All we can do is assess near-term price action, and if that near-term price action starts to affect the broader view, you know, then we can call it a reversal. As it stands right now, it's just a very clean monthly opening range. Cameron says, yes, thanks. Hey, more than welcome, man. Welcome aboard. Great to see you in the room. That's euro, dollar, yen, euro, yen, US dollar, Kiwi. And last but not least, dollar CAD. I don't really have anything very strong to say about dollar CAD right here, except I just wanted to highlight the same level that we talked about last week. If you guys remember, dollar CAD was highlighted on one of the intraday trades. Look, if you've been playing the short side off of 32.88, you've still been making really nice scalps. It's just that this thing is likely to give you more chop fest before it actually gives you more clarity. So let me zoom out real quick. Here's the formation that we've been looking at essentially for the last 3 weeks. Okay, and we've continued to respect that upper median line parallel. 32.88 is the reversal day close. And 33.35 is the high day close. Both levels are pretty big. And near term, the bias from my standpoint remains weighted to the downside below 32.88, and a break above 33.35 is needed, to keep that long side in bias. If that happens, you have a long dated 618 at 34.57. But until we break this region, guys, I just don't think it's worth it to play the long. That's just my, humble opinion. But if you look at the momentum signature, also not giving us much confidence to continue playing the long side. In fact, you've been getting some divergence into those last two highs with a continuing coiling up in momentum. So these typically will charge real nice moves. I think, prudence pays in a trade like this, and we'll get the clarity. Obviously, guys, the broader bias remains weighted to the upside. I think dollar CAD goes much higher. In fact, I'd be more than willing to play the long side if we do make that breakout into that 34.57. I think this might offer a big resistance level. And while, consolidation patterns like triangles and wedges are typically, continuation patterns, you can quickly see a check of the monthly open, 31.38, if not key support at 30.60 before you start to move off again. So we'll have to play this. There's not really any major key loonie data on tap this week. So most of the price action will be steered here by way of the US dollar. We'll keep an eye on that. So another one we'll keep on the radar charts for now, with a general downside bias below 32.88 for the immediate term. Any questions on any of the charts we presented last night? Kiwi CAD, US dollar, euro, dollar yen, or euro yen? Mark Haverman saying Euro CAD, please. Looking to buy around 149.06. Euro CAD. Let's take a look, Mark. 149.06. So I'll just let you look at this daily chart real quick, and this is sort of what I'm mapping out on as far as the daily levels are concerned. The 618 or the 786 rather retracement you're looking at here is from the decline off the highs from 2014, and that coincides dead on with the median line off the lows. So I'd be a little concerned of getting into a trade at that level, looking for a break of these highs, unless you're looking to play it into this high, Mark. I'm not sure what your target is on that. Let's see what the near term looks like. Euro CAD, Euro CAD. Cameron says, I see you saying sell dollar CAD with a stop against 32.88. I'm not saying that per se, Cameron. I'm saying if you get to 32.88, and that's a great question. Those are the exact questions you need to get early on. Check it. I'm saying if you get rallies into 32.88 and you have opportunity to take stops against that, and you get some triggers like you did here, or actually that wasn't the best trigger. This was probably a much stronger trigger, some divergence into the highs of the trigger break. Those are the trades you want to take in dollar CAD. First of all, Cameron, the reason it's on the radar chart and not in the update is because it might not be ready for us to necessarily operate on right now, but we'll be looking for this, over the next 48, 24 hours. I'm not really strong. I haven't taken any trades on this since last week at all. In fact, I think last week we got one scalp on it. We might have gotten stopped out at break even. But my point being is you need to know the major key levels. So 32.88 invalidates the short bias, and 33.35 puts you long. It doesn't necessarily mean every time we get to 32.88 we're just going to sell it. You need to still see some sort of momentum trigger, something in momentum to put you into the trade. That's the difference between what we're looking to do here, Cameron. Everything's much more near term. So if I look at a 5-minute chart, for example, and we start heading towards that 32.88 level, let's bring up dollar CAD. So something like this. Really nice support trigger. 1, 2, 3, 4, 5 point, 6 point trigger, right? It means it's tested that slope 6 times. And price is coming towards 32.88. That's a trade I'd take, right? You got a real nice triggered momentum, and you got a nice high to trade against. You probably take entry somewhere near 32.70, 10 pip stop. You're looking for 30 pips on the move, right? You know that we're looking for a quarter of the daily ATR typically per scalp. So that's a trade I'll take. From where you are right now, you don't really want to do much, okay? Because every move away from 32.88 has been a quick snapback right back to that level. So does that make sense? The mentality is a little different. It's not just you want to sell against 32.88. You still got to get some sort of trigger to go ahead and put you into that position. Cameron, I hope that offers some clarity on that. He says, okay, I got it. Right on, brother. All right. So, sorry, back to Mark. Wanted to be long-term on the hourly. 149.06 is the 38.2 from the latest move up for EuroCAD, right? So you're saying 130. Okay. Is it 38.2 from here? I see what you're looking at. From this one, Mark. So he's looking at this retracement, which puts the 38.2 at 149, and that's a confluence with that median line. I see what you're looking at. I see what you're looking at. One thing I would say is just that resistance that way I just noted on the daily chart. Hold on one sec. 786 you don't need. That 236 is not necessary either. Okay. Anyone new to the room, also a quick note, just remember that you also have that camera button in the top right-hand corner of your GoToWebinar screen. So any of the charts that you see that we discussed here today, you can always just take a quick snapshot and it'll save that screenshot for your own references if you need it, whenever. So feel free to snapshot as many charts as you'd like here. But a quick look at this, Mark. I would be looking at this pivot level here being pretty big. I guess that would be the first area of support. The stop loss would be where? He says 148.20. Yeah, could be a good position. Could be a good position. I'm not really crazy necessarily about the long euro until we see euro dollar and specifically euro yen make some sort of base, especially with euro dollar coming off resistance and the expectation for a pull lower. A move into 149 would be definitely appealing for a near-term long, but I don't know as far as the target. Hey, Michael, great to see you in the room. It says I'm new to the room as well. Nice to see you, man. Feel free to ask any questions that you have. I guess the target on that mark would be 151.86, 151.93. That's a huge confluence. 618 off the high, 1618 extension off the low. That would be sort of major resistance I'd be looking at. Yeah, but it's possible. Absolutely. Near term for me, I'm looking for a move of the weekly opening range. Technically, a break below this would actually put you bearish. So I'd be looking for a pretty conviction trigger down there. That's all I have to say. I typically don't really like taking stops against regions. I like having a near-term low or a high to trade against. So I'm not really crazy about the stop. But other than that, yeah, this is the sort of near-term bullish invalidation I would be saying would be in focus for the euro CAD setup. Just remember that daily chart. Remember that daily chart. This is, obviously a conviction resistance that we've seen already multiple times. He says, thank you. You're more than welcome. Oh, Mirhad also says, I'm new to the room as well. Well, welcome to all you guys. The more the merrier. So glad to have you here. We do this every morning, Tuesday, Wednesdays, and Thursdays. So guys, feel free to have your voice heard if you have any questions. Mark says, I keep forgetting to go top down. So what Mark is talking about, guys, is top down analysis, which is basically you start off with the wider time frame, whether it's weekly, I tend to start off with weekly, go to daily, then go straight to the 30-minute, but always absolutely imperative and critical because you will tend to miss larger structures, longer term moving averages. Everyone, who's calling for euro dollar parity and all these, clowns that were going crazy when we were breaking down, weren't just looking at a basic trendline support that dates back all the way to 2008. You wouldn't have seen that on a 30-minute, 4-hour, or anything else. Everyone who was calling for gold to go down to $800, right, or whatever it is that they were calling for, wasn't looking at a basic, trendline support that dates back to 2006. Okay, this is a weekly chart. So it's absolutely imperative to keep these larger, major key levels in view. By the way, you might have seen me tweet this yesterday on MB Forex. This is another huge trade that we want to be in focus heading into this week because the implications that it has for the dollar. Everyone's been watching the gold trade slowly erode, specifically with the break below 1155. That was the last real major support zone before this long-term trend line that dates back, like I said, to 2006. You saw us bottom out there. The low week close comes in at 1096 or 1098 rather, and that was the exact low last week. Over the next 2 weeks, that 10,098 low week close also intersects that multi-year trendline support. So before everyone gets all excited about, $800 gold, just know that we're at support. I'm not saying that it's not going to move down. I'm just saying that I'm not looking to initiate anything new here unless we rally towards 1150 and get a nice short trigger up here, or we break back below this, and then I'll look to sell rallies towards that 1067 level. Obviously, a longer-term target takes you all the way down to 980, but this is huge resistance. This is near-term support. And this is on the weekly basis. So on the daily basis even, they're seeing that we're putting in a pretty tight weekly opening range here as well. Some slope support. Saw us hold that decline that we made there on the 9th. And now you're looking at basic trendline resistance off of the August highs. And momentum still trading above 40. So you don't really want to be initiating any new shorts on gold just yet. And I do think we get more clear definitive bias here for gold once we get through the FOMC. Remember, gold's, historically its two major plays have been A, hedges against inflationary pressures, which we have the opposite problem on that right now, and B, safe haven in market turmoil, which, yeah, we did see a pretty big spill in equity markets, but even then, gold really respected the formation that we're trading within. So it's going to be interesting to see what happens on the gold trade moving deeper into this week. Okay, so those are the trades that I'll be following. We'll be following over the next 24 hours. Again, we'll give you an update later tonight. Looking ahead, the major event risk is going to be, like I said, remember tomorrow morning we have CPI, and then in the afternoon we have GDP from Kiwi, so we'll be watching both of those trades. A quick look at some other trades that we were following from last week. Aussie Kiwi, we finally made that confluence break and finally cleared this formation. So if this is legit, you want to stay constructive above 112.12, which is the monthly open. You're getting some kickback here today. Here's what the intraday chart looks like. This is last week's scalps, guys. All the levels are the same, haven't really changed. And 1212 is going to be the bullish invalidation level. The weekly opening range low, which comes in at 111.87, would be what would shift our bias to the downside for Aussie Key. So specifically over the next 24 hours, as you get through that Kiwi FOMC event risk, broader moves in the Kiwi, I think, are going to move this. Aussie, the minutes last night did charge some downside moves. Still no conviction on trading it, guys. It's been really hard for me because I love Kiwi, but there's just not much clarity for me here from a near-term prospect to get involved. So we'll continue to track its near-term movements, but even the weekly opening range, really ugly in comparison to the Kiwi Dollar, which is sort of super clean as it gets. So we'll be looking for definitive price action in both of those to offer some guidance on Aussie Kiwi, which again has marked finally that break of that near-term consolidation structure. Sterling Oz, another one from last week that we were watching. Also, I just wanted to highlight here, you made an opening range stretch for the month. You're testing the opening range low. Major key support 214.19 into 215.27. Much wider range ATR, almost 300 pips. So if you're new to the strategy, it might not be the best candidate to get involved with, but I think you have a really nice September opening range, and we'll be looking for that break to give us some guidance. This is the structure that we were trading in last week that we were talking about. Long story short, I'm still favoring the downside below the weekly open, which is essentially still at 217.50. But with lackluster performance and what we're seeing in the Aussie crosses, I'm going to wait to see if we get a break of the weekly opening range, of the monthly opening range rather, excuse me, before taking any further moves on this one. It's a really strong uptrend, so I don't want to get caught really trying to fight this, and you are coming in some support. So the conviction break would be a move sub 214.20 to keep us short, or a break of the weekly opening range high to put us back on the long side, targeting the high day close at 220.37. So pretty clean levels there as well. Not the easiest trade just because the wider ATR, but still on track. Near-term testing support here. Let me snap these lines for you. There we go. Oh, that was the last trade I wanted to go over. Sterling dollar. Sorry about that, guys. Here's British pound versus US dollar, coming off that resistance. So again, remember this was actually on the radar charts on Sunday. 154.47, 154.60 was a major resistance zone that we talked about last week. Major key support and the bullish invalidation level is right here, 154.30 or so, 154.30 and 40. We talked about this region at length last week, so I don't want to necessarily beat a dead horse, but really can't stress how important that region is, near term. You have the monthly open, which is 153.40. You have this pivot, which is a long-term structure, which I showed you guys yesterday on Daily FX for the formation here dating back a few years. And you know, if this thing is going to make a pop towards that key resistance at 55.60, 55.70, we'll really need to see a hold here. So while the near-term focus remains weighted to the downside, I showed you guys this chart yesterday, especially on the back of the CPI data that we got out of the UK. Here's what CPI looked like last night. And it was pretty much in line with expectations across the board, month on month, year on year, and even the core was right in line with expectations. You did see a slight drop, but that was expected. Long story short, one of the major or the singular mandate, I guess, for the BOE is price stability as well. So if inflation is being subdued or they're not getting, or they're unable, let's say, more properly to stoke inflation, that's really going to tie the BOE's hands. In my opinion, still one of the most hawkish central banks out there outside the Fed. So you're seeing sterling take a little hit here. Long story short, as I said in the post, you know, I'd be looking for a job towards that 53.40, 53.30 level, and I'd be looking for possible long entries here. As far as trying to take the short at this point, you really have no conviction stop. So, you know, it's hard to justify getting involved in this latest drop here for the pound, but you are pretty clear on where the levels are to play, and 53.40, 53.30 remains key support on the near term. Any questions on the British pound? All right, guys. So we'll wrap it up here. Again, like I said, we'll be back tomorrow at 8:30 Eastern to review it all over again, see what kind of setups are being offered into the release of the U.S. inflation data. And then obviously Thursday is going to be the fireworks, guys. We'll have a longer session on Thursday morning. We'll try to go over all the dollar crosses here heading into the probably what's going to be the most important interest rate decision this year. Till then, best of luck trading, guys, and I will see you tomorrow morning. Cheers.